Welcome to Wyckoff Power Charting. I'm Bruce Frazier. I'm your host. And we are going to have a discussion today about the importance of contrary opinion thinking. And for many of us who are on a determined path to investment mastery or trading mastery, which is really an exercise in peak performance trading, we have a big job to do. We have a lot of elements that are essential in the process of being a successful, masterful trader. And today, we're going to take the first step on a discussion about investment mastery, where we're going to talk about specifically about contrary opinion thinking and why it's very important to our investment success. We started with a group called the ZIMS Group, which I've written about in a blog. And this group was started in 1988 and went for 9 years. And it was a group of professional traders and investors that worked together to identify the important steps in having and executing a trading plan that could be considered to be a high success investment plan, which has elements of mastery in it. And this was an incredible journey. I took this journey with Joe Turner, who is here today, and Hank Pruden, who is going to be here in spirit. So with that, I will stop talking and I'm going to introduce our special guest, Joe Turner, and welcome, Joe.
Great. Bruce, thank you very much. And thank you for the opportunity to be part of this program that you've started. I think it is so wonderful, and so many people are going to benefit from the program and the ideas that you're presenting here. The topic for the discussion today is one of the crucial steps to this whole process of investment mastery is contrary opinion. And the reason that contrary opinion is so important is that successful investing is a really tough business. And there's just a number of reasons, but the basic fact is we're human. And it's that humanness that gets in the way of extracting all that we can from the markets. In fact, evidence in the proof is that the average investor lags way behind what the investment returns and the investment opportunities are in almost every asset class. There's an organization, Dalbar, research organization, that for the last 30 years or so has measured the average investor's performance essentially compared to the mutual fund industry. So Dalbar studies the money flows into and out of the mutual funds, and from this they can determine what the average investor's performance has been relative to fund performance. And what you're looking at here is a pretty remarkable picture, which is the average investor, which is way over there in the orange on the right-hand side, has woefully underperformed, not just for 1 year or several years, but the average investor consistently and significantly has underperformed the stock market and all other asset classes. And the reason is its emotions. That's the human part of what we're talking about. The stock market is one of the few markets when there is a sale with products at half price or that nobody shows up.
Well, Joe, this is a pretty bleak picture because we ought to be able to just go buy the S&P 500 and be able to get a return that's consistent with the return that is present there for the last 20 years, which is 7.2%. But in fact, this data suggests that there's a big gap between investor returns and investment returns. And so something's going on in the human psyche here. Something's going on with the average investor, which is the average of all investors that Dalbar has been able to capture in this study, that says that average investors are doing something really wrong. And I'm guessing that, well, Joe, let me ask you, what is the average investor doing really wrong here?
Well, contrary to the formula, which is buy low, sell high, the average investor does just the opposite. They buy high, they sell low. And the reason is they need security, they need confirmation, they basically need their emotional state to tell them, okay, it's okay to do this. But the problem is our emotions are affected by all the input, and we tend to do all the wrong things.
So it could be like investment news related, financial news related. It could be related to the crowd psychology of all of our friends doing the same thing at the same time. And so what happens is the elements, the forces of all these things together cause people to buy at high prices and then to hold until prices are low and then sell at low prices.
And you put your finger on the issue of all of the input, all of the information, all the evidence, all of our friends, neighbors, the media, the experts, they're all telling us to do one thing. And in fact, we should be doing the opposite.
And so therefore, the art of contrary opinion thinking. And so, which is an age-old practice. This has been known on Wall Street since the beginning of time, which is to be a contrarian. But there's an art to being a contrarian. It is not easy to do.
So let's back up just a half a step in what is contrary opinion. And that's when you take the opposite opinion of the sentiment held by the majority of information, the majority of thinking, the majority of people, and evidence out there. And essentially, when everyone thinks alike, they're not really thinking, and everyone is likely to be wrong. That is pure, that's the evidence, that is what comes from proven by the Dalbar information there. So the key is, what we need to do is to do the opposite of what the prevailing wisdom, what the prevailing common sense thing appears to be.
So that sounds so sensible and so easy to do. What's the problem here?
The problem is we have security in numbers, and in fact, we have a friend who developed a model out there. It's called the adoption diffusion model that really does put together time. It puts together behavior of the participants in the marketplace. It takes price, and then also it incorporates emotions. That is, the aspect of the emotional pendulum that goes from one extreme to the other, from fear to greed. It's said that the stock market is nothing more than fear and greed superimposed on the business cycle.
This particular schematic, which was developed by our dear friend Hank Pruden, who is here in spirit today, I first saw this almost 40 years ago, and at the time I saw it, I knew it was important, but it took me a long time to really grasp all of the essential elements of this incredible schematic.
There's a lot of moving parts to it, Bruce, but as you said before, it's really an elegant model because it encapsulates everything that we need to know, from how price behavior works and how people participate in it, and how the emotional pendulum works to to create the model.
So in a few short minutes, let's see if we can help to illustrate how the human condition is present in the price cycle. And so the price cycle is this curve, this big curve on top. And you can see here for Wyckoffians that Hank, who was my co-teacher in the Wyckoff courses at Golden Gate University, he has these elements in here: accumulation, which is a Wyckoff term, markup, distribution, markdown. And so you can see here the flow of the cycle from bottom to top, and then again, over and over and over. But what is genius about this is the way that Hank was able to put the adopters of a trend, the adopters of an idea on here in the form of sentiment. And so we can see here that at the absolute beginning, we have the innovators. And the innovators might actually be the people that founded a business, or they're the very earliest people that are into the market, into the stock market at the very beginning. We call these in Wyckoffan terms the composite operator, which is a fiction, but it's a useful heuristic. And the idea here is that with the composite operator, these are the very, very savviest, smartest investors out there that are moving large sums of money in and out of the market over the course of a cycle. And so we see them as being the innovators or the early adopters. And they're the ones that are in when the news is the bleakest, things couldn't look worse, and they're buying the market or stocks at bargain basement prices. Then you have the early majority that comes along, and they get into the trend in the early, call it the first third of an important move up. And so the early majority comes in after the early adopters and the innovators have gotten all the shares that they intend to own. They've wrapped them up, so to speak, and taken supply out of the market. Well, by the late stages of the advance, you have the late majority coming in. And the late majority are in because now the news has gone from being very bad to getting better to being very good. And the news helps to give courage to the masses to start to be a participant. And for a period of time in the uptrend, the late majority is succeeding. Prices are going up. They're benefiting from the momentum of the trend as it goes up. And then at the very end, you have the laggards that come in very late, and they come in as distribution is forming. And at the midpoint here is when the early majority and the early adopters begin to actually reduce their holdings in the market or in the stock that's in question, and they are starting to sell their positions to the late majority and thereafter. Joe, what are your thoughts about this model?
Well, and this goes to the heart of the point of maximum optimism. There is the top. That's when you have all the majority and the laggards are in the market. So now that you have them all in, there's nobody left to buy. There's only sellers. And that's why this model works, because now you start the markdown phase. And so we're at the peak of greed. And now we'll just cycle all the way back down as the market comes down, and we unwind the process here back to fear.
Richard D. Wyckoff talked about the real rules of the game, and he cautioned that if you don't understand the real rules of the game, that you shouldn't be a participant in the markets. And this model addresses, to some degree, there's a lot more to learn, and we'll get to some of that in a minute, but the real rules of the game are really expressed in the essence of this model, which is the bell curve of adoption of the trend as it goes from being very early to being very late, and who participates when. And the early adopters and the innovators tend to be there over and over and over at the early stages, and the late majority and the laggards are consistently there late in the trend, late in the cycle, over and over and over. And so this is something that we want to be on the right side of, and it has very much to do with our theme of the day, which is contrary opinion.
Let me add one thing, Bruce, before we move on here is, as you said, understanding the rules of the game, and this takes an honest self-appraisal, and we'll talk a little bit more in a minute about that. But I can tell you that I have many times looked at a new concept or a new investment theme or idea and read something, and I believe that I'm an innovator. And then I read this a second time or a third time, and I think, okay, this confirms my earliest appraisal. I'll start doing a little bit more research, and I'll find 5 or 6 or 10 articles on whatever that theme is on the internet, and I still think I'm an innovator. But really, where am I at that point in time? I'm probably somewhere between early and late majority. So you have to be honest in this, in understanding the rules and being honest with yourself and trying to identify where am I on this process.
And one last point here about contrary opinion is that there's a time to employ contrary opinion, which is at the beginning of an important uptrend and as the accumulation phase is ending. And in the markup phase, we want to be with the early majority. We want to be in the uptrend.
We want to ride that trend.
So we don't want to be contrarians all the time. And this is part of the conundrum. This is part of the problem, is we want to be contrarians at the extremes. And so this is a tricky business. And so we will have a further discussion about that as we go on.
Well, and that right then and there, you have to determine where in the trend you go from one extreme to the other. So let's look at one way to assess whether we're in fear or greed. And there's an interesting little tool out there of many, but CNN has developed something that they call their Fear and Greed Index. You can Google this, you can monitor this during the day, but it essentially takes 7 different components that measure investor sentiment. They put them together into this composite, and it has a scale of 0 to 100. But what you can see in the red circles here is when you get readings below 20, you get something in the teens or single digit. What you're talking about is fear is very prevalent in the marketplace. Now, it's not just their fear, it's your fear as well. But this is where you have a tool that can offset what your own emotional state is, and understanding this and working on this so that you have a command of emotions and mental and psychological aspects of investing, you take advantage of this. So as you can see, and this is geared for maybe the intermediate term, where you're going to get 2 or 3 moves a year. We have a 3-year history, and we've got 5 or 10 buy-sell signals during the time period. So you get 2 to 3 of these signals a year, where you either want to be reacting to fear or reacting to greed, taking advantage of fear and taking advantage of greed. But you can see very simply that when we hit an extreme fear level, what happens? People are out of the market. The only thing that can happen now is they put money back into the market, and the market goes up. So here's one little tool that goes right to the heart of seeing where that pendulum swings between fear and greed during the course of a move.
And this is not where. This is where we gain mastery over ourselves, is we acknowledge that we are subject to the same emotions as everybody else. But at the same time, we recognize that if we have the right tools and we turn our instincts into the understanding that when there's extreme fear, measurable fear in the marketplace through sentiment indicators, such as this example, we want to start to think about being contrarians. We want to see the fear develop in the markets and prepare to act in opposition to that. And so, and we're not going to feel good doing it. So we feel the fear, but we also have the understanding through our methodologies that we will use the extremes of this psychological point where these red circles are and start to look for the opportunities to buy stocks or the market or the asset class we're interested in at low risk. This is a low risk point. The very high fear point is the point of low risk. And so then we can turn to our Wyckoffian characteristics or whatever other price mechanisms we use to identify what and where to buy. But we know that the fear that exists in the marketplace in the majority of investors is an opportunity for us. And we must develop the instincts to do that. Joe?
And much of this is easier said than done. And Bruce is describing something that's it's very hard. And it takes some real dedication on each of you individually to be able to dig into yourself. And because successful trading, all of this is about self-control. Successful results come from risk control. Risk control comes from self-control. Bruce earlier brought up the concept of the ZIMS group when he opened up the discussion here. ZIMS group was a gathering of individual traders, money managers, individuals that all had an interest in working out their problems. And they had a friendly group. We had a friendly group to discuss these things. And one of the first discoveries that came out of this was something that Hank Pruden put together as a result of all these meetings that we had, worked with a performance coach, Van Tharp, and they basically broke down what were the individual tasks that top traders did well that gave them the results that they got as being a top trader. And the very first process starts out with self-analysis, understanding yourself, understanding and how to gain self-control over the mental, the emotional, and the psychological command that you need to be able to successfully conduct investment operations. So it all starts with the self. When the group started back in the late 80s, there was a new technology that was just coming out, and where we had our meetings was kind of the hotbed or command central for the introduction of NLP, or neuro-linguistic programming, which if you understand the terminology or look at the words neuro-linguistic programming, neuro is mind, linguistic is communication. How does the mind communicate? And programming, of course, is change. So if there are things that you do that are unresourceful, if you get in unresourceful states, unresourceful emotions during the conduct of your investment decision-making, you need to spend some time in self-analysis. You need to develop tools that will give you command of the mental, the emotional, and the psychological. And that's really what came out of this exercise or this group of ZIMS traders, is we laid problems out on the table and had a sympathetic audience to try to understand ourselves better. Hank developed this model. Hank and Van Tharp developed this model that I think is just an amazing way to think. And maybe Bruce will have more of this as time goes on. But we took not only upon ourselves to go through the 10 tasks and how each of us developed that, we took it a step further and took these 10 tasks, and I think you did this, Bruce, in your courses at teaching at Golden Gate, but taking these 10 tasks and reading books like Market Wizards and going through and reading a chapter on a given wizard, and how and extracting from that reading how that trader went through these 10 tasks. And it was just a wonderful exercise to see how others, including those people that are really, really good at their craft and are definitely way down the path of mastery. So wonderful exercise, a wonderful model for everybody to develop the 10 tasks.
One thing that Joe is really good at is he's a brilliant, and I use that word seriously, he's a brilliant model builder for decision making in the financial markets. He is really good, and his partner, Martin Pring, is also remarkably good at this. And they develop decision models for the financial markets for different time frames, intermediate, long-term, short-term. And the thing about Joe and Martin is that they're quite disciplined at executing their models. They follow them very closely, and when their models give them a shift or a turn, they act on that, and they're very disciplined about what they do. So they're very good at modeling the decision-making process that's important to them in managing client portfolios. And so I just wanted to say that because maybe we can get Joe to come back and talk about how to do model building, because that CNN indicator was quite impressive, but it's not the only way to measure sentiment. There's other ways to do that. And so, and there's other time frames, other indicators, et cetera. So let's see if we can't get Joe to come back sometime in the future. So,
Bruce would love to do that and share some of the experiences and knowledge that I've been at this game and the challenge for 50 years, and I love sharing things that I've learned and things that have helped me on that path.
Cool. Okay. Well, we have to button this thing up for today, and we hope you've enjoyed this discussion. And let's move on and tell you about a blog that I wrote back April 8th, 2017. You can go into the archives for Wyckoff Power Charting, find the ZIMS group. There's a nice discussion there, things that we've covered here today. But there's also a link to the journal where the 10 Tasks of Top Trading, written by Van Tharp and Hank Pruden, is available, and you can go in there and read that. So I encourage you to go look at this blog and link in. And then also, if you'd like to be on Joe Turner's mailing list at pringturner.com, it's free, and they don't share your email with anybody. And you can go in right there, go to their website, go to blogs, and then sign up for our newsletter. And there you can put your email address in and receive their current thinking. So with that, we are near the end. And Joe, thank you so much for joining us and having this discussion. Let us know if you'd like to see us do more of this kind of thing. Wonderful. Take care. We'll see you next time.